A few weeks ago, Brian and I came to you to share some of our investment philosophy here at 10 Capital. This week, we're going to walk you through part of our process. So we talk all the time here at 10 Capital about making sure you understand your purpose. What are we trying to achieve? What are the trade-offs? What plan will help get you there? And then we finally get around to the portfolio and what specific investments are right for you. How do you make those choices? This week, Brian and I are going to walk through the framework that we use to help make those decisions.
So when we're talking about our investment process, previously we talked about asset allocation and creating a portfolio of different asset classes. And the second part of our investment process is fund selection. So within an asset class, how do we slot in a fund that we think will perform best over our investment horizon in that given asset class? And so we built a framework for how we think about fund selection. So Tim, maybe you want to start by talking about investment strategy.
Yeah, the first one is just looking at the strategy, and there are a lot of different components of this. Again, these are meant to be 5 to 6 minute videos, not 5 to 6 day seminars. But in short, what we want to know is if we're going to, in particular, have an active manager, somebody who's making selections, can they drive extra returns? Can they produce returns above that benchmark? Or is this an asset class that's better to use a passive approach? And so that's what we look through. It's actually fairly determinable, particularly in certain types of economic cycles. And so that's a big part of our process. Certain things like US stocks, very difficult to generate extra alpha within that thing. Other things like municipal bonds, certain parts of the international or emerging markets are places where people have been able to show a lot more alpha. So we'll start there, delve into the manager's process, understand who and what we might want to use.
Right, and so Tim, I think that's a perfect example. You know, our second point, we say here's the strength of the sponsor firm. So to use Tim's same examples, if it's a municipal bond fund, we know that that's a more laborious activity to go through all those individual securities. So we're going to want to be with a firm that we think has a big enough investment team to handle that process. Another example might be, you know, if we're investing in an asset class that's really big, highly liquid, and very efficient, we may want to use a passive manager. And in that case, we might want a firm that has more scale so they can drive down the cost to us.
And speaking of fees, fee structure is something that's absolutely important to us as well, but always within the context of value. And so a common question I'll get among 401k participants is a typical one is, well, shouldn't I buy this one? It's cheaper. Well, there may be an apples to oranges type comparison, something like US stocks, where it's very hard to get a competitive advantage. Let's get it in a very low cost option for you. What are things like emerging markets that take a lot of due diligence, may need active management where they can drive alpha, but again, covering the world's a tough job. Paying up a little bit for that is still worth it for the value you get from owning that asset class. So understanding where you can get that great value and where you can't, again, a key part of our process.
As we like to say here, it's not what you make, it's what you keep. And that's why tax efficiency is fourth on this list. And in some asset classes, there's vehicles that are more tax efficient than others. One example would be if we're in large cap US equities, we can own an ETF and not generate any capital gains versus a mutual fund that you may be impacted by other investors' investment decisions that'll create tax consequences. So where we can, we want to be in the most tax efficient vehicle. And the fifth criteria is liquidity. And so we just want to understand what we're investing in and how liquid that is, with the general framework that if something's going to be less than liquid, we want to have a higher expected return to make that trade-off.
Yeah. We've talked in the past about the LIVE methodology, and to that point, if we're going to give up a little bit of the L, we better get it in the form of income or volatility reduction or total expected return over time. But again, how are these trade-offs work? Every one of those boxes from a couple weeks ago, each of the different types of assets that exist out there, from US stocks to international to municipal bonds, et cetera, need their own analysis, and they have their own things that drive, again, how to maximize expected return in light of cost and tax efficiency. And so this is, again, a big part of our process. We don't pick our things out of Barron's top funds or ETFs from the year before. We're always looking ahead and encouraging you to do just the same. With that, I'm sure we'll be back to reiterate these points over time, but thank you for joining us for our investment philosophy and process series.